Thanks for tuning into Worldview. I'm your host, Neeraj Shah. Our guest today is arguably one of the most experienced research professionals in the world at large. He and his firm cover almost the entire spectrum of the investable universe, both in geography and in terms of asset classes as well, possibly. Charles Gav joins in right now from Gavekal Research to talk about his worldview on almost all things investing. Charles, so good having you. Thanks so much for taking the time out. I hope all is well with you. I was looking at your latest piece, which was published, I think, on the 27th of February, wherein you spoke about, going back to the Wixel theory of how the U.S. economy's position in the four quadrants is shifting and what it could shift to over the course of the next 12 months. I would love to understand from you, how do you look at the U.S. economy's growth and the resultant central banking action, because what the U.S. will do will have far-reaching implications on almost all geographies.
Yes, it usually does. Let me put it this way. Most people for the last 12 months have been more or less expecting a recession anytime in the US, and it did not happen. We were, in fact, in what we call in our jargon, a deflationary boom, which means economic activity accelerating and inflation decelerating or falling. And these are periods during which P ratios expand, and we have usually very strong bull markets. But due to a certain number of factors, one of them being that interest rates are too low in the US, we are probably moving from this deflationary boom, which is heaven for the financial markets, to an inflationary boom. So contrarily to what most people are saying today, I'm not worried at all about a recession in the US. I'm worried much more about inflation accelerating. And if inflation accelerates, as I believe is very possible for a lot of reasons, then what we will have, the central bank will be forced to raise rates, and it will be a much more difficult environment for equities and bonds. So you see, the difference that I have with most people is that most people seem to expect a decline in interest rates engineered by the central banks in the US and elsewhere. And as far as the US is concerned, I expect the central bank to be forced to raise rates sooner rather than later.
Is there a timeline mismatch? Because I think the world looks at investing in a very short-term way, and maybe the belief is that 2024 could still be a year wherein rate cuts could come in. Are you in agreement there? And do you believe this inflationary boom and thereby subsequent rate rises is a factor of what will happen in 2025 and beyond?
No, it could happen. It could happen anytime for a very simple reason is that, okay, that's the fundamentals. But as I have said, interest rates are too low, and they are too low. The short rates are too low, the long rates are too low, and the corporate bond rates are also too low. So my view is that the market have anticipated bigger and longer lasting declines in inflation rate. To a certain extent, for those of us who have a little bit of memory, this is what we had in 78, or 79, the central bank cut rates in the US. And instead of having a normal recovery with falling inflation, inflation took off. And Mr. Volcker had to raise rate aggressively in 80 and in 81. So I think the situation is very similar to the end of the 70s. The markets believe that inflation is a temporary problem. But let me put it this way, there was a French economist called Rueff, very well known, and he used to say that inflation is subsidizing expenditures that have no return with money that doesn't exist. To make a long story short, maybe the quantity of money being printed is lower, but the subsidizing of expenditures that have no return, for example, take the US budget deficit, which is immense and getting bigger, are going through the roof. So you cannot keep subsidizing money with money that doesn't exist, expenditures that have no return. Another way of what I'm trying to tell you is that normally in a good recovery like the one we had in the last 12 months, I would have expected the US budget deficit to go down. It went up. They are spending money as if it were going out of fashion.
Yeah, well, that's true. Just following up on the comparison that you did to the earlier era, Charles.
Yep.
Do you expect a Walker shock-like phenomenon wherein the banks would have to raise it too fast and kind of lead to a recessionary period as well?
That's well, what I know is that now interest rates are sufficiently low, according to the work that I do anyway, for prices to start going up. So we are moving from, in the previous period, we had prices that were still structurally going down. Now they may structurally go up. Okay, if they structurally go up, the central bank, the markets will have to accept the idea that the next move in interest rate is not down,
But
it's up.
Yeah. Okay. So you do you reckon that it could be a surprise at large and that could trigger hitherto?
Oh yes, it could trigger a little bit of let's say bad feelings in the market. If interest rates go up, usually it's very bad news for what is called long duration assets.
Right.
Long government bonds, long bonds, and of course growth stocks.
Yeah.
And so if something like that happened, since the markets, if for example in the US have been driven by 6 or 7 growth stocks, it could have an inordinate impact on these guys. But you see, something that I never do, I try to understand where we are, where we might be moving, but I never try to make any forecast, because anybody who make a forecast is looking ridiculous pretty quickly.
Yeah, that's true. I mean, maybe compressed cycles are making that too, making people look like that too. Just wondering, Charles, what the investing implications you laid out, what could happen to growth stocks, etc. When the first up move of interest rates began, people spoke about how the decade at large could be a year of higher for longer interest rates than what we've seen in the previous decade. And it would also have implications for multiples, the P multiples that you assign almost not just growth stocks, but any stocks, the discounting factor, etc. Is that a net negative for risk assets like equities?
Well, yes and no. You see, to be perfectly simple, if you try to explain the variations in P ratios, which is your question, if I understood it.
Yes.
You simply make a ratio between the S&P and the price of oil. Okay, if the S&P goes up faster than the price of oil, multiple expand. If the S&P underperforms oil, multiple contract. Why? Because the economy is nothing but energy transformed. So if the S&P goes up, it means that the economy is transforming energy profitably. If the S&P goes down versus oil, it seems that the economy is not able to transform energy. It's too expensive. So right now we are more or less on the cusp between the two. For the last year in the stock market, or 2 years, the stock market has outperformed the S&P, and P ratios have expanded sort of. In the next, well, the question is, for the question on multiple is resting on only one thing, it's oil. If oil goes from 80 to 100, the P ratio will contract. If oil stays where it is, probably not.
Well, last question on before we take that break, Charles, and a lot of people consider oil to be a deep insider of what global growth could look like. The fact that despite all the disruptions, if oil is steady at these $80 per barrel mark, does it portend badly for growth, and do stock markets follow that?
No, if oil stays at 80, we survive without too much difficulty. But if it goes from 80 to 100, then we're in trouble.
Okay, fair call. You're not making forecasts, so I want to ask you to make one, which is fine. Now,
But wait a second here. I don't want to. The money management is not about finding the winners. Money management is about finding the losers, not to buy them. So whatever is what's happening in the next 12 months, I don't see how you're going to make any money on the bond market in the OECD. So what you should avoid is government bonds in the OECD. The rest is literature. You can keep shares, you can buy gold, you can do what you want. But the main message that I want to transfer is don't buy government bonds in the OECD.
okay, don't
Because
buy.
they will lose it. They will lose in all scenarios.
Okay, don't buy government bonds in OECD. I believe you've spoken about how not to buy. I mean, I was reading your other notes as well, and you've laid it out very beautifully for people who follow you that, you would be buying put options on both bonds and on stocks to protect against the move into the next quadrant as well.
Yes.
Okay.
That's basically the idea is that if a problem starts, it will start in the bond market. And it may, so you buy puts on the bond market, but it may, if it's big enough, have an impact on the stock market. You buy a fewer puts on the stock market. That's the way to protect.
Okay. I want to give the viewers a teaser of what will come in the next segment, Charles. And I want to kind of just squeeze in a question on emerging markets in India and how do you see them? Because I remember a year ago when we spoke, you'd come out with a fairly constructive piece on how India has changed some of the things that it does well. But I want to just first understand your view on EMs before we take that break. We'll talk about India in the next segment. But emerging markets, what's your view in light of the view that you have around interest rates?
It will be a pleasure.
Yeah, but will it be a pleasure for investors into emerging markets, Charles?
Let me try to step back a second here. The problem with the emerging markets in Asia, but also in Latin America, up to very recently, is that they always had their growth constrained by their current accounts. To put it bluntly, most of them are importing oil, with a few exceptions, and this oil had to be paid in dollars. So you needed a current account surplus in dollars to get the dollars to buy your oil. And if the dollar went up, everybody was killed in Asia or in Latin America. In the last 18 months or 2 years, because of the events in Ukraine, a lot of countries can now buy their oil in their own currency, which means that the exchange rate risk is now borne by the fellows that are selling oil, not by the fellows that are buying oil. And so they can diversify that risk by accepting payments in a lot of currencies. So it means that suddenly you have broken the link that prevented you to grow as you should have in the past. And that was the oil dollar, the obligation to pay for your oil in dollar. So what it means is that a new monetary system is going to be emerged in the next 20 years or so that will be not centered on the US dollar, although the US dollar will remain very important, but on bilateral relationships. The problem that you have now in India is that the Russians have too many rupees and they don't know what to do with it. So what India has to do is pretty simple, is build a kind of bond market in which the Russians will be able to deploy their rupees and that will take interest rates lower in India, which will be a good news for the stock market. So what we have now is find a certain number of technical solutions for India, for example, to pay for their oil in rupee, and that is squarely in the hand of the Indian government. They have to offer financial assets to the Russians that the Russians will find interesting to own for the long term. So it requires a little bit of house cleaning, but it's not very difficult.
Okay, Charles was talking about a few things that the Indian government needs to do in order to make it more attractive for foreigners to put in the Indian bond markets. He cited Russians, but I guess it's true for some of the other economies as well, with whom India can possibly engage in a rupee trade for the crude imports that India does. Now, Charles, I would love to understand, you wrote about this back then too. Not everything in terms of that rupee trade or a non-dollar trade has worked out. But be that as it may, if we assume that over the long term this is going to turn out to be true, and let's assume Indian bond markets, we are going to be included in the JP Morgan bond index, presuming the Bloomberg bond index, so the depth out there increases, so on and so forth. Does this all pave the way for better current account dynamics for a large oil importing country like India? And would foreign investors view that very positively?
Well, yes, foreign investor would that positively. And instead of, let me put it this way, India for the last 40 years or so, every time you were growing a little too fast, your current account deficit moved into deficit, and you had to slow down the economy, raise rates, and basically it was a stop and go system. Now, if suddenly your current account went into deficit because energy imports went through the roof and you had to pay them in dollars. So now if you can pay your current account deficit with your own currency, then suddenly you don't have to look at the current account deficit of India, including energy. You just have to look at the current account of India, excluding energy. And there you have, first, pretty large foreign exchange reserves, and second, you are in equilibrium or in surplus. So what I mean is that suddenly you have to look to know when the Indian government is going to tighten. You have to look at the current account X energy, and if it moves, as long as it is positive, and as long as inflation is subdued in India, you have no problem. And for inflation to be subdued in India, the easiest thing to do is to allow a constant, small revaluation of the rupee against most currencies. Like that, you will have a very subdued inflation. So I've spoken previously about the US being a deflationary boom. If you have no massive monetary policy mistake made in India in the next year or two, India should enjoy a massive deflationary boom for quite a while. Your interest rates are still fairly high. They're at 7 now. So they could go easily to 5 or 4 over the long term, especially if foreigners are buying to build up position in a country which has one of the few good demographics in the world.
That's true. Tell me, Charles, money flows into markets like India, not as much in an idiosyncratic fashion as much as it is a part of an emerging market pocket, if you will. And emerging markets per se, by virtue of what China is going through or some other economies are going through, are not quite giving returns. So how attractive could, albeit a large market, but how attractive could a market like India be to foreign capital, which is looking at emerging markets as a bucket, even though India may be having these demographics and these growth numbers?
Okay, let me put it this way. The way I look at India and China is pretty simple. China doesn't need foreign capital. They are an excess saving nation and always have been. So I seldom buy equity in China, except when they are dirt cheap as they are now. Okay? Because they don't need my money. India is almost always a nation that doesn't have enough savings, probably also because you are very young. Makes sense. So it's always a good idea to invest in countries that have a deficit of savings in the equity market, because they will make it, the market will be attractive for you to send your capital to India. So my inclination on a structural basis would be in bonds in India, in China, and in equities in India. But the problem is that the equities in India are a little bit expensive today.
Always been, yeah.
And the bonds the equities in China are very cheap. And the reverse is true for the bond market. The bond market in China is a bit expensive. And the bond market in India is a bit cheap. So cyclically, I would probably recommend to build a portfolio that would be Indian bonds and Chinese equity. But that would be out of a portfolio that for the last few years would have been Indian equities and Chinese bonds. So I'm just trying to rebalance a little bit the portfolio here. But what I'm saying is that India will need capital for the next 10 years so easily just to build their infrastructure. And they will have to make that attractive for foreigners. And why not buy equities there structurally? You see, the Indian market is expensive, okay, but the profits are growing very strongly. So if you do the P ratio of the growth rate, India is kind of okay.
Yeah, true. My final question, Charles, can Indian growth sustain for the better part of the next few years at a point of time when the world growth is looking so uncertain? China, Europe, you mentioned about the US, high inflation possibility and higher rates possibility, so lower growth maybe.
The beauty of India, to a large extent, that it never paid any attention to the rest of the world. You have been always self-centered. As a percent of GDP, your export and imports are minimal. They're very slow. You have so much potential in India just by organizing your infrastructure, your roads. And probably the biggest effort in India will have to be made for things like nuclear energy. So you have to find a way to finance the development of your infrastructure. And that will take at least 10 to 15 years in China. It took more than 20. So what happened in the rest of the world should have very little impact on the Indian economy. My belief is that the Indian economy is now in the hands of the Indians. And if they do correctly their long-term views, organizing a bond market, monetizing the savings in India and so on, to invest in infrastructure, what happened in the rest of the world will have no impact on the economy, but it may have a temporary impact on the stock market. Let's say you take a beating, I don't know, in Wall Street or what have you. Well, if you take a beating in Wall Street, I suspect the Indian stock market will go down in sympathy.
Right.
But nothing to do with India.
Okay. Fair call. Charles Gav, such a pleasure talking to you and getting your insights. We're out of time on the show. Would have loved to talk more, but look forward to talk to you more often. And thanks for the wonderful writing that you and your team do on Gavekal Research.
Thank you so much.
The pleasure was entirely mine and ours. And viewers, thanks for tuning into this very special episode of Worldview.